Ray Dalio recently shared that the only solution to avoiding a depression is a 3% budget deficit pledge. The problem is that if you implement that, you are directly going into a recession. So we'll discuss the situation, the budget deficits, the factors there, how a 3% pledge solution immediately creates a recession because it is an application of pain. Nobody wants to do it, no politician will do it, therefore the only consequence is worse than a recession scenario. And then we'll see what does that mean for investors, and we'll conclude on a note on Ray Dalio, as there were some very interesting comments in the previous videos. Let's immediately start with the deficits, the situation. This is the situation. It doesn't look good. The US government is planning to spend more than 7% of GDP more than it takes in, thus spending like drunken sailors, what Druckenmiller says. And this is not data invented by someone on YouTube. This is the Congressional Budget Office, and here you can see how 18% of GDP is what they get in, 24% is what is expected to be spent. And the situation is that most of the spending, most of the deficit is on interest, which is on the accumulated debt over the past, thus creating an even more unsustainable situation that leads into huge difficulties. And you can see here how the average debt interest rate is 3.34 as of March 2025. 5 years ago, it was just 2.2. On 36 trillion of debt, that's a huge difference. And then you can say, Sven, yes, but in the past there were here huge also interest payments. Yes, but then the interest rate in the 1980s was above 10% and the debt to GDP was just 30%. So that made a huge difference. And here you can see how the public debt is increasing as a percentage of GDP and is projected to increase steadily going forward on very exuberant assumptions. If we look at the budget outlook from the Congressional Budget Office, here you can see how they expect the debt to reach 120% in 2035. However, if we look at the assumptions going in, first, we have real GDP growth of 2% on average. We have the estimation over this 10-year period to never ever see a recession. No recession, no issues whatsoever. Inflation to be kept low at 2%. Unemployment, no issues there. No unemployment increases in payments whatsoever. All projections are made on no issues ahead, no floods, no recessions, nothing. And the problem is that if you go to a 3% pledge or 3% deficit from 7 to 3, that immediately creates a recession that even worsens the case there. Because if we look at the federal finances, we have now a 7% deficit. If you want to bring it down to a 3% deficit, you need to take 0.9 billion from spending. Thus, you need to bring spending from 7 to 6.1 billion. The problem is that you need to take this money away from the total spending from something. However, if you take that money away and bring the spending down to 6 trillion, the problem is that the government spending is a huge contributor to GDP. 19% share of nominal GDP for the government spending. Thus, if I do simple maths, 7 minus 4, at least minus 3 to GDP growth. GDP growth has been around 2.4% over the last 2 years. Minus 3, that's a recession. And then you have to calculate. Unemployment goes up, less government spending, less money, less income, because there is a government multiplier that increases GDP the more the government spends, and then that hits again the necessary spending there with lower revenues, making the situation even worse. Unemployment goes up, everything looks uglier, interest rates might also go up, because look at the estimations there are for all interest rates to just go lower. The problem is that if you want to cut significantly spending, this is 3% of GDP, no politician will do that because immediately you lose the next elections. If we look at Trump's favorability, it went down from above 50%, it went down to 42 something. So in the few months of Trump trying to do something, okay, it's also his own fault, but as you start cutting, people start liking it less and they want to pick someone else. And the government is spending like drunken sailors. From a political perspective, I don't see an incentive for politicians to change that. Because if that one that was before spent so much, I need to spend even more in order to gain the votes, because it's all a popularity contest. And we know how the most popular people end up. It's not like the smartest. If we go to Druckenmiller, his suggestion is to cut entitlements, because the current seniors, you're going to get 100 cents on your invested dollar. Future seniors looking at 5 or 10 cents on the invested dollar if there is a debt crisis, a fiscal crisis, and there is financial Armageddon. So it's not unreasonable for entitlements to be cut, for current seniors to get 85 or 90 cents on the dollar to prevent a disaster. But there is the political problem. 35% of those that have voted in the United States in the last election is older than 65. The next batch is from 45 to 65, going into those entitlements pretty soon. And only 35% of people is younger than 45 that vote. And consequently, if you want the votes, you need to spend more on things that are on interest. So if no politician will apply the painful medicine, the consequence is something worse than a recession, which Ray Dalio discussed. That means loss of purchasing power of the dollar, more printing, lower interest rates, financial engineering that makes you poorer. That's inevitable. Perhaps a depression, and then really taking a lot of time to readjust to normal productivity, to lower debt levels and things like that. All the debt bubble that we are living in has to revert, and that would take 5 years. You can see here in the 1930s, GDP went down 30% in the next few years. Let's hope we don't have such a big recession, but when it comes to the investor takeaway, we are now begging the government to cut spending to have a few recessions in the next 4 years. 3 recessions, 4 years, that everything, let's say, adjusts a little bit, and then we can go on a healthier note forward. We are practically begging for a recession as the best case scenario. But the main mantra is we can go without recessions. Sven, what are you talking about recessions? I wasn't even alive when the last recession was around. If we look at gross domestic product, the last real recession was 2009. This cannot be counted as a recession. So the current political mantra and the expectations of people is that we will never again have recessions. However, whenever there was long period of no recessions, there was the big one. No recessions, big one. One after the other. So the next one will pay for all those small recessions that we didn't have in the past. And I think we are 3 recessions overdue, which can also look like a depression. Now, when it comes to investing, when I would make a valuation model, I would always calculate 2 recessions in the next decade, which would then give me, let's say, a perspective when to buy, when to sell. However, now we haven't had a recession over 15 years. Therefore, when I start talking about recessions, there are so many comments. Sven, this time is different. They will do this. They will print. Everything looks great. Yes, but the risks are piling. And now, what do I have to do? Calculate, yes, for the recessions, but also calculate for an Armageddon scenario, perhaps. So we have to see how those decisions will be applied, those painful potential decisions, or not. But the main takeaway for investors now more than ever is to be hedged. We have discussed this even before the current turmoil 4 months ago. Now, of course, it's more expensive to be hedged, but might still be the best option. If we look at the S&P 500 put option for June 18, 2026, a little bit more than a year, but of course the cost in February was just 17. Now we are at 40, which means that the cost of hedging more than doubled. Another way to hedge is to do it like Buffett, to just be in cash and wait for better opportunities. Buffett knows something that we don't know, as always, which means that it's very interesting also to consider as an option. When I mention hedges, there are always many comments. Sven, how is your hedge doing? This is my performance for my personal portfolio year to date, which means my hedge is doing okay. So just a message for all the naysayers. Now, what is still the Armageddon scenario that we have to implement? I can say I don't know what it is, or better to say I don't dare to think about it. We recently discussed Spitznagel. He says how we are not yet there, but when all this financial bubble issues thing reverts, we might be looking at a crash of 80% for the markets. Now, just a correction, 80% in real terms. If the Fed starts printing, the markets might be flat, and then you say, okay, the markets are flat, but real purchasing power would be 80% down. Also, future seniors looking at 5 to 10 cents on the dollar, that is something that simply is inevitable as the dollar loses value. We'll be talking about gold. I'm sure gold will go to 5,000 sooner rather than later, and 10,000 should you own gold in your portfolio is the next video. And I have promised you a note on Ray Dalio, and as there are always many comments, Ray Dalio is a scammer, he's forecasting doomsdays for the last 10 years, things like that, and he's just scaring investors. He talks in a 100-year framework. We might not be alive. Ray Dalio underperformed the market by half over the last decade. And my take is he didn't underperform, you'll see now. And the thing is that we have to understand his key messages, and he outperformed everyone out there. First, key messages. These are must-watch videos, how the economic machine works, principles of dealing with the change order. Then we must also understand that he started by discussing how the economy works, the machine video. Then he discussed inequality, which led to consequences, voting, Trump elected, things like that. So he was pretty prescient on those calls. He said cash is trash. Then we had inflation, cash was trash. Then as interest rates went up, he said now it's a little bit better to invest in cash. Correct again. And then now he is explaining the debt cycles. As the interest payments went from $500 billion to more than $1 trillion, interest rates rising, and it means a clear non-sustainable situation. However, on the investing, he outperformed anyone. I think he has 18 billion or something like that of wealth, all collected on fees through his Bridgewater hedge fund. Thus, he has more money than all of us, which means Ray Dalio outperformed us. Okay, his fund performance is something else. He didn't beat the market, but he is offering a solution of not losing, of just preserving wealth to ultra rich people. That's something different. You have to understand what he does, who are his clients, what's their problem, and how he solves that. And of course, you can do better individually, but I don't think there is a better historian out there for economics, finance, and investing. Thanks for watching. I'll see you in the next video.